So today we'll be looking at company income tax. So the provision of what the company income tax. So as the name implies, company. So a company is an artificial person that is separate and distinct from those individuals who establish the entity. So when you say there is a company, so that company is different from those set of people who are the owner of the company. So it's an entity on its own that can sue and can also be what? Be sued in the name of the company. So anything that is carried on by the company is binding on what? On the company itself, and not what? And not on the individual who establish or who establish or incorporate the company. So for us to say there is a company, there must be what? The word what? Limited or PSC after the name of what? Of that particular what? Business. So that will make you to what? To determine so that what? Such is a company. So basically this company income, so we want to look at how to what? How to tax the activity of what? Of this kind of what? Kind of taxpayer. So this company income tax is governed by the Company Income Tax Act, Cap C 21, Law of Federation of Nigeria, so which is the law guiding the company income tax. And this company we are talking about, the tax is payable on preceding year basis. So that means all the activity carried on for the previous year will be liable to tax in the current year. So all your transactions, let's say for instance, we are now in 20, so all the transactions that you did throughout 2025, depending on your accounting date, will be what? Will be liable to tax in what? In 2026. So the tax is on what? Preceding year basis. And because the tax is on preceding year basis, so it is collected by only the Federal Inland Revenue Service. The FRS is the relevant tax authority in charge of collecting the company income tax. So unlike when we have some other taxes that are collected by both the Federal Inland Revenue Service and state internal revenue service, but basically this is collected by only the Federal Inland Revenue Service, which is now called the Nigerian Revenue. Either can be in two forms. So we have the two forms are what? Either a company is a Nigerian company or a foreign company or a non-resident company. So we have what? Both a foreign company. So each of these companies are able to earn tax. So in the case of a Nigerian company will be liability of all by that company, irrespective of where the income is being made from. So if you are a Nigerian company, you are going to pay tax on your global income, that is on the total of all your income, even though if that income is not derived or is not generated in Nigeria, that income will be liable to Nigerian tax, which is the company income tax, subject to a double taxation agreement. So that means if a company is a Nigerian company, they are going to pay tax on what? On all their income, whether that income is made in Nigeria or is made from outside Nigeria. So that income will be liable to tax, subject to a double taxation agreement, because it is possible that if the income is being made, part of the income is being made from outside Nigeria. So the country where the income is coming from will have. So as a result of, in order to avoid double taxation, so they are going to give a kind of relief, tax credit for what? because that income has suffered tax in other countries where the income is coming from. And this is also done in order to encourage company and taxpayer to disclose all their income. So it will assist taxpayer in disclosing all the income generated by them. Say a Nigerian company are those companies that is incorporated with the Corporate Affairs Commission in Nigeria. So companies that are incorporated with the Corporate Affairs Commission in Nigeria are called what? Are called Nigerian company. So all the companies that are incorporated with the Corporate Affairs Commission in Nigeria, the CAC, they are what? They are those companies that are called what? Nigerian company. So for a company to be regarded as a Nigerian company, that company must have what? The CAC number that is usually issued by the Corporate Affairs Commission in Nigeria. So when such is available, such company will be regarded as a Nigerian company in which their income. As I was saying, I said a Nigerian company. Those are the companies that are incorporated with with Corporate Affairs Commission, who will be issued the CAC number. So for those companies, they are liable to all form of to company income tax on the totality of all their income. Then we also have a non-Nigerian company or a non-resident company. So these are companies that does not have a permanent establishment in Nigeria. So there are those companies that are not registered in Nigeria. They don't have an office. They don't have where they operate. So a permanent establishment in Nigeria. They are not incorporated in Nigeria with CAC. Such companies are regarded as non-Nigerian company or non-resident company. So this company, they are also liable to to Nigerian tax. So because this company, they are not a company that is having a fixed base in Nigeria. So that means they will also have other places where they operate. They will have their headquarters somewhere. So they are only going to be liable to Nigerian tax on what? On the portion of income that is attributable to operation in Nigeria. They are going to pay tax here in Nigeria only on the portion of income that is attributable to what? To Nigerian tax. Only on the portion of income that is attributable to what? To Nigerian tax. So that is the only portion that they are going to pay tax in Nigeria. So where they don't make any any profit or income in Nigeria, they are not going to be liable to Nigerian tax. So only the income that is attributable to operation carried out in Nigeria is what they are going to pay company income tax on. So basically, this now tells you that all category of company, once a taxpayer is a company, whether that company is a Nigeria company or a non-Nigeria company, are liable to company income tax. So the payment of the tax will now depend on on if the company is a non-resident company, to know whether that income is being in Nigeria or not. So as I said earlier, that the federal government is in charge of collecting this tax through through the Federal Inland Revenue Service, which is paid in which the tax is payable on preceding year basis. So those are the bases that we are expected to know as far as this particular aspect is concerned. Then the tax law has categorized company into various forms. So we have three categorization or category of company. So we have those companies that are regarded as small company. So we have those that are called the medium company, and we have those that are the large company. So basically for now, those are the three category of company that are available According to what? According to the tax law. So the three category of company available are what? Small company, medium company, and large company. So how do we categorize this company? To know whether a company is a small company or a medium of company will depend on the situation of a company will depend on the amount of turnover generated by such company. So the amount of turnover generated by a company will show whether if a company is what is a small company or is what is a large company. So the amount of turnover generated. So as we all know, so a small company, those are companies with an annual turnover, of 25 million naira and below. Any company with an annual turnover of 25 million naira and below are regarded as what? Small company. So company with an annual turnover of 25 million naira and below. Look at that word, annual. That means throughout 12-month period, total sales that you made as a company does not exceed 25 million naira. So such category of taxpayer are regarded as what? As small company. So there will also be young company. So those are companies with an annual turnover of 45 million naira and less than 100 million naira. So company with an annual turnover of above 25 million naira and less than 100 million naira are called what? Medium company. And for small company, their tax rate is what? 0%. That tells you that what? Small company are not liable to what? To payment of what? Of taxes. The one for medium company, their tax rate is what? 20%. Those are companies with an annual turnover of what? 100 million naira and above. Annual turnover of 100 million naira and above are what? Large company. And the rate of tax is what? 30%. So this categorization will help you to know the rate to be adopted when you are asked to compute what? Company income tax. But take note, where the examiner did not give you the turnover of in a question. So that means if the examiner did not give you the turnover in a question, it will be difficult for you to categorize all these companies into their categorization. So where the examiner did not provide information about the turnover, so for you to compute the company income tax, you are going to assume large company. In that case, you are going to use what? 30%. Take note of what I said. Where the information about turnover is not given, so that means we will not be able to categorize the company into their form. As a result of that, we are going to add large company and adopt what 30% as what as the tax rate to be what to be used in what in the computation of what of tax liability. So we now need to look at these three categorization one after the other. So in the case of small company, so which you said was small, those are companies with annual turnover of 25 million naira and below. And what the rate of taxes was 0%. So that means they are not liable to tax payment. So the fact that a small company is not liable to tax payment does not exonerate them from where? From registering for tax. As a small company, you must also register for tax with the relevant tax with FIRS and also what? File return. You must file your return as at when due. Failure to file your return because you are now a small company is also what? It's also liable to what? To penalty and what? It's an offense which is liable to what? To penalty. So the penalty will not be as a result of you not filing, not for what? Not for not paying. So as a small company, you are also required by law to register with FIRS and what? And also file return. Because the reason why you must register is FIRS, the tax authority, they don't know you. If they don't, it is based on what you give them that they will be able to identify that yes, truly you are a small company by what? By filing your tax return. And when they say filing of tax return, that means what you are providing all your what? All the components of your what? Of your financial statement. All the components of your financial statement are what form what? The return that will be filed to the Federal Inland Revenue Service, which is also inclusive of what? The computation of what? Capital allowance and so as a small company, the fact that you are exempted, you must register for tax and also file return. Then small companies, they are no longer liable to what? To payment of what? No longer liable to what? Withholding tax on what? On their income, since withholding tax is an advance payment of tax. So if a small company can establish to a vendor that they are a small company, so that vendor is not expected to charge them withholding tax. But where the vendor does not know and he has already charged them withholding tax, any withholding tax suffered by them will be refunded to them back by what? By the relevant tax authority. Because it's possible that you want to deal with the vendor may not know that you company. In that withholding, where you have suffered any withholding tax, any withholding tax suffered will be refunded to you back by the relevant tax authority in form of what? In form of cash. Then also small company cannot what? They can no longer deduct withholding tax, provided that what the supplier is having what? Is having a valid thing, and what the transaction amount does not exceed 2 million naira in a calendar month. So small business, small companies, they cannot charge or deduct withholding tax. So happening that vendor to that supplier that want to supply you is having what? Because if that vendor is having that means the vendor has already been captured by the relevant tax by FRS already. It's already in the tax net. So that transaction will not escape the tax net. But where the vendor does not have a valid thing, it is possible for that transaction to escape the tax net. So small company cannot deduct withholding tax, provided that the transaction, a valid thing, and the transaction does not exceed 2 million in a calendar month. Because they are looking at it that if you deal with 2 million with a single vendor, if that vendor demands 2 million, if you multiply, not make it to be a small company again. So that is in the case of that. Also, so the Finance Act stipulates that Federal Revenue may prescribe the form of account. I told you that the small company, they are expected to file the return. So because this company are if you look at the turnover, we said 25 million, which is small, they may not be able to also have the power or the financial capability to engage the service of an auditor. The tax law gave them a right to request that the FRS should allow them to file a lower form of account, like a management account. So the tax law gives them that right, that FRS can give you an avenue to file a lower account in order for you to encourage you as a small company. Then also, as a small company, so they are also granting they are exempted from payment of tertiary education tax. So the fact that you are not going to pay company income tax, you also not be liable to payment of tertiary education tax. So tertiary education tax, those are taxes that are payable by companies in Nigeria. So all companies that are incorporated in Nigeria are liable to tertiary education tax, which is at the rate of either 2%, 2.5%, or 3%, depending on on the year of assessment. It is that tax that you usually see when you go to those of us that are familiar with higher institutions. When you go to most of these federal institutions, you see in some of their buildings, third front. So that is where the money is coming from. So it is the money that is coming from this tertiary education tax, which is payable by all companies that are incorporated in Nigeria, except small company and non-resident company. So those are the companies that does not pay the tertiary education tax. Also, as a small company, they are also what? They are also not liable to what? To capital allowance claim during the period that they are regarded as small company. Small company cannot claim capital allowance during the period that you are a small company. We know that capital allowance is a relief that is deducted from your assessable profit to get what total profit before charging to tax. So that means if you are not going to pay tax to the government, any asset that you use for the purpose of the business that will make you to qualify for capital allowance will not be available for capital allowance, because you don't expect government to give you back the money, because there is no place where you are not going to pay them. There is no place for you to relieve the capital allowance. So the capital allowance is also not available as small. The capital allowance will only be available for relief when they cross the threshold of 25 million naira. You either qualify as medium or large company. So those are the criteria that govern the activity of small company. So when this law came up in 29, it came out in Finance Act 2019, which became effect from 2020 year of assessment. They know that most of these taxpayers, they are taxpayer on a normal day. They are not willing to pay tax. And taxpayers, they are also wise. They may decide to use this because the government has brought up a small company that will be exempted from tax. Taxpayer may decide to use this as an avenue to evade tax. In order to evade tax, the tax law also came up with Anti-Abuse Acts, in which that we say that any attempt by a company to split their transaction that were carried out prior to the commencement of the Finance Act among two or more companies to benefit the exemption of small companies will be aggregated together and regarded as one. It is possible because some companies they want to benefit the exemption given to small company by exempting them from payment of tax. They can now decide to incorporate more than one company. They will go and incorporate more than one company and be doing the same businesses, and ensure that the turnover of those companies did not exceed 25 million naira. Where that is done, and where the tax authority find out, if that is done, there is no way the tax authority will not find out, because that is some of the reasons why they expect you to file return. They will be able to link the transaction together. And where the tax authority, where they find out, they are going to aggregate all the transactions of those individual companies together as one and charge it to tax. The company director and those that are engaged in those activities will also be prosecuted accordingly. So because they know that some taxpayer company, they don't even, whether company or individual, they don't want to pay tax. In order not to for government not to lose revenue, they decide to come up with what is called an Anti-Abuse Act. Then also after the commencement of the Finance Act, any attempt by taxpayer to incorporate new company. Instead of, it may not be company that has been in the system. Some taxpayer, they may decide that, okay, since I'm going to ensure that I do not go beyond this 25 million. They now incorporate two or more companies in order to be doing business, in order to benefit the exemption that is being given to small. Where that occurs, also, all the transactions will also be aggregated together for the purpose of tax, and the directors and those that are engaged in that activity will also be prosecuted accordingly. So basically, in order to avoid taxpayer from engaging in acts that will help government from engaging in tax evasion, or those acts that will make government not to generate revenue. So they now decide to come up with this particular act to be able to look at the activity of taxpayer. So as a company, those companies that are liable to tax, they are going to be liable to tax in their name, in the name of the company. Company are liable to pay tax in their own name. They're also liable to pay tax in the name of their principal officer or agent. Maybe they have an agent that is working on their behalf. The tax belonging to that company may be paid in the name of that agent or the representative in Nigeria. They're also liable to tax in the name of their receiver or liquidator, where bankruptcy or liquidation exercise has been commenced on on such company. So basically, a company can pay tax in its own name, in the name of what? Of the agent or a representative. It can also pay tax in the name of what? Of a liquidator or a receivership. So those are the way in which a company can pay taxes. So those are the various ways in which a company can pay taxes, which are the different which can pay tax. So these are the various ways in which your company are liable to in which company are liable to the payment of company income tax. So then we now have the other three. I'm coming in this network. Hello, can we hear me?
Yes, sir.
Hello. Okay,
Yes,
yes.
sir.
So for the other category of company, so that is for small company, we have this other category which are medium or large company. Those are so the process of determining tax relating to that is the same process for medium and large company. So for medium and large company, so the process of determining their tax are in four ways. So there are four bases of what determining tax liability of either a medium or large company. So which are the following bases are what? We have the total profit basis, we have the minimum tax basis, then we have the turnover basis and what dividend basis. So those are the four bases of what? Of determining tax liability of what? Either a medium or a large company. So those that are liable to tax, so you can determine their tax liability using what? Using four bases, four way. So four method of what? Of determining their tax liability. So we are going to start with the first one, which is what? The total profit basis. So the total profit basis involve what? The determination of the total profit generated by what? By the taxpayer. So involve what? Determination of the total profit to be generated by the taxpayer. So that is the total profit basis. So the determination of the total profit. This total profit can also be called what? Taxable profit. So determination of the taxable profit generated by the taxpayer, which is what? Which is the first basis of what? Of determining what? The tax liability. And to determine this total profit, this involves the process of what? Involve the process of doing adjustments to what? To the account prepared by the financial accountant. By the time the accountant want to prepare the accountant will have prepared the account using accrual basis and using what? All stating all expenses, those that are what? Allowable and those that are what? Not allowable. And for the purpose of computation of tax liability, it is not all expenses that you state will be allowable. There are some expenses that are disallowable and there are some that are allowable. Also, it is not all income that will be liable to tax. There are some income that are non-taxable income. But by the time the accountant want to prepare the statement, the profit or loss account, the accountant will have what? Will have included all those in his what? In his. So the process of determining total profit now involves the analysis of what? Of adjusting the account prepared by the what? By the financial accountant. By what? Looking at what? Those that are allowable and what? Those that are disallowable and looking at what? Those that are taxable and those that are what? Non-taxable. And this total profit basis, there are two approaches that can be adopted under this total profit basis. We have the net profit or approach, net profit or loss approach, and we have what? The turnover approach. Two approaches can be adopted, the net profit or loss approach and what? The turnover approach. As I said, we have what? The net profit or loss approach and what? The turnover approach. So the net profit or loss approach and the turnover approach. So let us look at, so we have under the total profit basis. Under the total profit basis, so we have what? The net profit approach and what? And turnover approach. Either way, when you have the same information, we give you the same answer. But there are ways, scenario whereby what you can use either of them. The net profit approach will only be adopted when you have information about the net profit. Where the examiner has already given you the amount of the net profit, please don't go and use the turnover approach because you may not have all the needed information to use the the turnover approach. So to use the net profit approach, the examiner will have given us information about the net profit. We must already have information about the net profit. Then how do we now determine the total profit using the net profit approach? You state out the profit given to you. We have the net profit or loss. It can be profit or loss. State out the net profit or loss. You have what? Either profit or loss in jacket. Either way that you have, they have You add disallowable, disallowable, disallowable expenses. There are some expenses, as I told you, not all of them will be allowed. So you add it back. You also add, after adding disallowable expenses, you also add back taxable income omitted. There are some income that are supposed to be liable to tax. But by the time they were preparing the accountants omitted those income as part of the income to be used in what? In preparing the account. So by the time you add these two, so you sum up these two and add it to what? As your what? So you add it to this. Then you less non-taxable income, non-taxable income included. There are some income that are called non-taxable income. Those are income that are not supposed to be liable to what? To company income tax. But by the time the accountant was preparing the account, he has already included them as part of the income. So you are going to less those income. You also less allowable. You also less allowable expenses, allowable expenses omitted. There are some expenses that are allowable, which were omitted during the process of what? Of computation of the tax liability. So this will be what? This will be deducted from this. When you now do this adjustment, so what you now have will be what? So you now arrive at your what? Adjusted stroke accessible profit. Please, for company income tax, your adjusted profit is also the same thing with your accessible profit under your company income tax. Take note of that. Your adjusted profit is also the same thing as your accessible profit under your company income tax. We also talk after that. This is not your total. What you want to calculate is total profit. You now say less what? Less loss relief. When we did loss relief, who can remind us which type of loss relief is available to company? Which category of loss relief is available to company? We have two types of loss relief. Which one is available to company? Who can remind us? Which of the loss relief is available to company? I need somebody to remind us which of the loss relief is available to company. We have for current year. So which one is available to company? Carry forward, sorry. We have the carry forward. Yeah, carry forward loss relief. Is the loss relief that is available to company. But in the case of the current year, it's available to both one, both individual and company. But company, they can only carry forward their loss. So you are going to relieve the loss. You have a loss. You look at loss brought forward, if there is any that they are bringing from previous period, if there is any that is brought from previous period in jacket because they lost. Then you also have loss for the year. If there is any loss for the year, if there is any loss that they have for loss for the period, if there is anyone for that period, you also consider it. So when you add up these together, this will give you your total loss. So this total loss, you are going to what? You are going to relieve it from this accessible profit. So you now have, so this is total loss. Total loss, you now have loss relief. So you remove that loss from the accessible profit. So that same amount, you are going to transfer it. You transfer it here as deduction. So you transfer. So after loss relief, so you have what? Add balancing charge. Who can tell us when do we normally have balancing charge? When do we normally have balancing charge? Who can remind us when do we have balancing? And what I mean is what will make a business to have balancing charge?
Okay. If
We know that it's
there
after the loss
is
relief. What we know that
if
it's
there is
after
a
loss relief. If there is what? A
You
disposal
guys are
disposal
before you
of
see
of
Bitcoin,
what?
now we
assets,
get breakdown now my connection.
and the proceed is higher than the tax written down value of that
Thank
asset.
you. Where there is disposal of what? Qualifying capital expenditure. And where the sales proceed is higher than what? Than the what? Where the sales proceed is higher than what? The
Mm.
income that will be added to what? As part of the income that will be considered. So you add what? The balancing charge. After the balancing charge, you now say what? Capital. You also look at capital allowance. You look at your capital allowance.
Jesus.
Tolulope, mute your mic. Oh. You look like capital allowance. Capital allowance. Capital allowance. So under the capital allowance, you can also have capital allowance brought forward. Capital allowance brought forward. You can also have capital allowance for the year. For the year. You have brought forward, you have for the year. So when you add, you can also have balancing. When do we have balancing allowance? Who can remind us? When do we have balancing allowance? You can also have balancing allowance. When do we have balancing allowance?
Since after the sales of a qualifying capital allowance, the tax written down value is higher than the sales proceed. That is when we
Yeah,
have
thank you.
balancing
Where the tax written value is more than what the sales proceed, you have a balancing allowance, which is what, an additional capital allowance. When you add up all this, that will give us what total capital allowance, which is what we have here. So this total capital allowance will be relieved. So we know that capital allowance is restricted to capital allowance relief. Capital allowance is usually restricted to what percentage? Who can remind us? Capital allowance is restricted to
to
what percentage?
2/3
Eh?
of the adjusted
Yeah,
profit.
2/3 of what? Accessible profit. 2/3, it will be relieved. 2/3 of what? Accessible of your accessible. So 2/3 of this profit that you calculated, this amount here, is what you are going to relieve here. Unless if this company is what? Is into what? Manufacturing or agro-allied. Those are the ones that what? There is no what? Relief of what? Relief, no restriction. So you relieve what? The capital allowance. So after relieving, you have a capital allowance carry forward. Any balance that you have will be carried forward to the next period as well. Capital allowance carry forward. So after you now have the capital allowance, so the resulting figure here, so the resulting figure from all this information of you deducting loss, balancing charge, and what capital allowance, the resulting figure will now give you what? Total profit, which is what we intend to calculate. So that total profit is what we intend to calculate, which is what you now have here. So this total profit is what you are going to now base your tax liability on. So total profit, you now base your what? So which is this? So you now calculate your what? Your company CIT. CIT at appropriate rate. CIT at appropriate rate of total profit. So whether it can either be what? Either 20% or 30%, depending on what? On the nature of the taxpayer. You also calculate tertiary education tax at appropriate rate of accessible profit. Tertiary education, why the CIT is based on what? This total profit. So tertiary education tax on what? So you also will calculate that tertiary education tax. Please, in the exam, where the examiner asks you for total tax liability, so you are going to add the two together. You now have a total tax liability. But where the examiner did not say total tax liability, so you are not going to add it together. You calculate them as well as separate individual tax. It is when he says total tax liability that what you are going to add them together as what as total tax liability. We also have, apart from this, I told you total profit basis. Under the total profit, it can either be net profit or net profit approach or turnover approach. Instead of using net profit, you can also have second one. You can also have the second one, which is what? Turnover approach. Turnover approach. Instead of the examiner to give you information about the net profit, the examiner will not give you. In that case, please, where you are not giving the net profit, don't go and do accountant for the examiner. Don't go and say you want to look for the net profit by all means, that you want to record it. So in that case, you are going to adopt a turnover approach. So yes, so failure to give you net profit, the examiner will give you what? The turnover of the generated by the company. So in that case, so where information about net profit is not available, you use your turnover approach, which will give you the same process. So, but where you have net profit, don't go and use turnover approach. So it is either adopt any of the two. Then we have what? So under that, we have what? To get total profit, we have what? Our total turnover. Total turnover. You look at your total turnover. After looking at the total turnover, after looking at the total, you know, less non-taxable income and frank investment income. Any non-taxable income and frank investment income that is included in the turnover, included in above. Any of this that has been included in the turnover. So you are going to less it from the turnover. So the resulting figure will not give you net turnover. We have a net turnover. So after getting the net turnover, so look at your, after getting the net turnover, so you now less all allowable. Under here now, you are only going to less allowable expenses. You are lessing all allowable expenses. So you less all allowable expenses. So when you less all allowable expenses, the resulting figure will now give you adjusted stroke accessible profit. So at this level, at this amount, this place here, what you are going to have here will be the same as the amount you are going to have here under the same scenario. So from here now, from this adjusted profit, the same thing is applicable to what? To what you have under what? Under this turnover approach when you are using what? When you are using total profit basis. So, but you first also, it is up to what? Adjusted profit that differs. From adjusted, you have what the same. From adjusted profit, if you are using turnover approach, you say less loss relief, less what? So loss brought forward, loss for the year, total loss, then you relieve, add balancing charge, capital allowance, and so on. So for you to get what? The total profit. So those are the two ways of what? Of calculating the what? The tax liability when what? When we have what? When we are asked to what? To adopt what? Total profit basis. So that is if we are adopting total profit basis. So which is what we have here. So that analysis is what I just said is what you have here under the what as was for what total profit basis. So we only have the one for the net profit. The one for the turnover is not here. So which is what I just explained to us here. So we now need to look at each of these items that we mentioned here one after the other. We mentioned what? Allowable expenses. So allowable expenses. They can also call it deductible expenses. So all expenses that is what? For the purpose of the business. That is rent. That is wholly, reasonably, exclusively, and necessarily the purpose of the business are what? Are allowable expenses. Business expenses that is not personal in nature. Those expenses are expenses such as what? Contribution to what? Approved pension fund approved by the JTB, any interest on loan obtained for the purpose of the trade or business. Nobody say you must what? You must use your money only to do business. If you are doing business, you can decide to go and borrow money to run your business. When you borrow money, you are going to be paying interest on that loan. Any interest you pay on the loan is what is an allowable expense, provided that loan is not from a related party. So we are still going to talk about what if the loan is from a related party, in which the interest will be restricted to certain amount. Then we have a bad debt written off, where a debt has completely been written off by taxpayer. It will become what an allowable expense. Under the following condition, the debt must have been occurred during the normal course of, so the debt that you are making as a result of your business, then that debt must have been included as part of the sales in that year. It's a current debt. So then you must have not deducted the debt before. Then you must have carried out all effort to recover back the money, but proof aborted by what? Like taking the debt, the customer to court to recover the debt, or suing him, or all those must have been taken into consideration before the debt will be regarded as a bad debt. Then rent of accommodation for staff, provided it does not exceed annual term. So any accommodation you are provided for the staff is also allowable. Then we have legal expenses in relation to the following. When you incorporate a company, part of the member of a company are what? When you incorporate a company, you are starting a business, you must appoint an auditor. You must also appoint a legal advisor, which is usually a lawyer, or you must appoint a secretary, which is usually either a lawyer or an accountant. You appoint all of this, you are going to be paying them as what for the company. That money you pay them is what is called a retainership fee. So the money you are paying them as what? As your company lawyer. So any retainership fee paid to them are allowable. Then general legal advisory, any work they do for you as general in nature, is also allowable. Renewal of short-term lease. Under the lease, we have two categories of lease. We have the long-term and short-term lease. Please, under the lease, you can have acquisition and renewal. Only the renewal of short-term lease that is allowable. You can have acquisition of long-term lease, you can have acquisition of short-term lease, you can have what? Renewal of long-term lease and renewal of short-term. Only the renewal of short-term lease is allowable. Any other form of lease will be disallowed. But you may be given a question whereby the example you have such situation, you assume what? It is what? Long-term lease, and what? You disallow such lease, where the examiner did not specify that this is a short-term lease. Then any cost of protecting or defending the business is also what? Allowable. Rent. So for you to do the business, as I told you, any money you are incur for the purpose of the business will be allowed, like rent. Rent you are paying for the building you are using for the purpose of the business. Cost of gifts to customer, incorporating element of advertisement. When you are doing advertisement, as you are giving them something as part of souvenir, which is for advertisement, is also what? Allowable. The other expenses that is donation awards are allowable for what? For corporate taxpayer. So under this donation, there are 4 categories of donation that are allowable for corporate taxpayer. So 4 categories of donation. So allowable donation. So we have what? Allowable donation. So we have 4 categorization of donation that are allowable to taxpayer. So these 4 categories, we have what? One of them is what? We have donation to recognized body, or they call it a normal donation. Second form of donation is we have donation to R&D, to research and development, donation to research and development. Then we also have donation to university, research institution, and other higher institution. Then we have the fourth one, which is what? Donation to government, donation for pandemic or government established fund. A good example is what? COVID-19 donation. During COVID-19 donation. So that is a good example of what? Of donation to what? To pandemic or government established fund, COVID-19. So these are the four categories of donation that what? That a what? A taxpayer, a company can make. So under this four category of donation, there are conditions that are available for this work, for this donation to be what? To be allowed. In the list of approved body, there are lists of approved body that donation are expected to be. Please talk to any political party, any social club. They are disallowable. Donation to political party, social club, clubhouse, or any form of what? Social gathering. They are what? Disallowable. Donation to what? Donation to church, mosque. Those are also what? Disallowable. Like donation to NASFAT, donation to what? Redeemed Christian Church of God. They are what? Disallowable. The only donation that is allowable are donation to CAN, Christian Association of Nigeria, which is what? The body recognized by the government, and what? Donation to what? To Muslim what? Muslim Congress of Nigeria. So which is what? We don't all what? All the what? Donation to what? MSSN. So any other donation to what? To religious body are what? Are disallowable. Then we also have the one that relate to our institute, which is what? Donation to ICAN. Please, for the donation to ICAN, the one that is allowable is what? Donation to ICAN building fund. Look at that word. That in front of that word, that particular word, before it will be allowed. If they tell you donation to ICAN alone, that is what? That is not allowable. It must be what? Donation to ICAN building fund. The one that is allowed is what? Donation to what? Institute of Chartered Accountant of Nigeria Building Fund. That is the donation that is what? That is allowable to be made for company. So this donation, there are conditions to this approved body. So there are certain conditions. One of them is that what? The donation, it must be made from profit of the company. You cannot be recording a loss and what? You are saying you are making a donation. So that donation will not be allowable in that year. Reason because what? You are what? You are declaring you are making a law. It must be made from profit. It's expected that the donation should not be made from where? Should not be made from what you already have. It must be made from when you make profit. Then also the donation should not exceed 10% of company total profit before charging the donation. It should not exceed 10% of the company total profit. This 10% is only applicable to what? To the normal donation and donation to research and development. I told you we have four categories of donation. This 10%, it must not exceed 10% of the total profit in the case of normal donation and what? Donation for research and development. Also, another condition is that what? The donation must not exceed 15% of total profit or 25% of tax payable, whichever is higher. This is in the case of what? Donation to university, tertiary institution, or research institution. It must not exceed 15% of total profit or 25% of tax payable, whichever is higher. Then also, the donation must not be capital in nature, except when the one you are making to university, tertiary institution, or other research institution for what? For developmental purpose. You must not say you want to donate and you are donating a house as a company to what? To as a donation. Yeah, no. Must what? Give them what? In form of what? In form of the cash. Then you now decide what to use it for. So it must not be what? Capital in nature. It is only when you are donating to what? To institutions that it can be capital in nature. Because that you are helping the government to what? To cater for their needs. So that's why what? That is allowable. Then it must be made to what? Approved funds. So as I said, there are funds that are approved, which we mentioned some of them earlier. So it must be made to what? Those funds that are what? Approved by what? By the tax law before it can be allowed. Then also another condition for the donation is that the donation must not exceed 10% of what? Accessible profit after charging all allowable donation. So this 10% of accessible profit, that's related to what? The pandemic or government established fund. For the pandemic or government established fund, it must not exceed 10% of accessible profit for the donation to be what? To be allowable. It must not exceed 10% of the accessible profit for the donation to be allowable in the case of what? Government established fund or pandemic COVID-19. Then you may also have a scenario whereby you be giving a donation relating to respect and what? And so when you have both in a question, I told you that it must not exceed 10% of the total profit before any deduction in that year. But when you have both research and development donation and what? And other donation, research and development donation will take precedence, will be deducted first before you consider other donation. Where you have what? Research and development and other donation, the R&D will be what? Taken into consideration firstly before what? Other donation. Then also for a company that is engaged in what? Research and development for commercial purpose, where their major work is to what? To carry out research and development as it was as part of their own work. So when they donate, any donation they make, they are going to be entitled to what? 20% investment tax credit. The reason because what? They are engaged in what? Research and development for what? For commercial purpose. So those are the conditions that are available for what? For donation to be made. You may be asked. So for what? For those conditions that are available for allowing donation. After allowable expenses, we also have what? Disallowable expenses. So number one disallowable expenses that you can talk of is what? Is depreciation. Depreciation, that is one of the number one expenses that should be disallowed. Reason being that what the taxpayer, the company is going to claim a capital allowance on that one, on that asset. So as a result of that, any expenditure of a capital that will qualify as allowance purpose to be disallowed. Any private or personal expense that's not for the purpose of the business will be disallowed. Provision, any form of provision will also be disallowed. General provision for bad and doubtful debt. Under this provision, specific. Specific is the one that is already established. Where you are told it is specific is provision for bad and doubtful debt is what? Provision for bad and doubtful general. The examiner may also give you a question whereby the examiner will not tell you whether it is what specific or general. In that case, you have to assume it is what general and what you disallow. Then any contribution towards unapproved pension scheme will be disallowed. Any what some recover under an insurance or contract of indemnity. The operational or preliminary expenses when you are incorporating a company, all those will cost you incur. Yeah, what? Because those costs will be capitalized. Expenses again. Then loss on disposal of non-current assets. Yeah, the nature of your business is not to sell your assets. So what we want is disallowed. Then loss on disposal of investment, so we also have legal expenses in relation to cost of acquiring new lease. I mentioned it earlier. Any form of lease acquisition, whether short or long, it will be disallowed. Cost of renewing long-term lease. When we did allowable, when we did will be allowable. The cost of renewing long-term lease will be what? Disallowed. Nobody asks you, they don't ask you to what to not to pay as at when due. Stamp duty on increase in share capital will be disallowed. Cost of defending traffic offense, all this will be what? Will be disallowed. Then tax or penalty borne by a company on behalf of another company. So any form of tax will be disallowed. Then defalcation by senior staff, because it's expected that you should carry out an insurance policy in which compensation will be payable to you. Any form of what? Stealing by Then gifts and entertainment. In the case of gifts can either be what? Allowable or disallowable, depending on what? On the nature. Entertainment can also be allowable or disallowable. So gifts, when you are buying the product of another company and you are distributing it to your customer, that will be disallowed. You are buying the product of another company, you are distributing it to customer, it will be disallowed. But if you are distributing your own product to them, that will be what? Allowable in form of gifts to them to be allowable. Then they either be to customer or staff. Any form of gift to staff is what is allowing. Once that person is what is your staff. Any form of gift is what allowing. Then also entertainment. Customer or for to staff. Staff is usually this is your common Monday meeting. You know, every company they usually conduct Monday meeting. After the end of the meeting, they will what? They will distribute item 7. All those money that is incurred towards what? Towards that one, item 7 and what? They are allowing. Also, entertainment of what? Of customer that is what? That is business related are allowing. But where it is not business related, it will be what? It will be disallowing. Then we also have loan written off. Any form of loan, you can have, this loan can also be in two forms. It can be loan to customer and loan to staff. Because it is not the nature of the business to be giving out loan. Any loan written off will be what? It's allowable, whether you are loan to customer or loan to staff. It is only where the company is what? It's a financial institution. You know, as a financial institution, a part of their services to render loan facility. And that loan they are giving you, they will have made provision for you to either performing or non-performing. So to know whether they are going to receive it back or not. So in that case, any form of loan written or where the company is not a financial institution, is to a staff or to customer. So travel expenses that you are incurring from your house to your work, yeah, well, disallowed. But travel expenses during working hour for official assignment are allowed. The advertising in form of what? In form of what? A permanent nature. That is, where you erect a billboard or a signpost that is what permanent in nature. Those will be disallowed. Because you are going to capitalize that item, it will be disallowed for capital allowance purpose. But advertising in form of what? That is not capital in nature will be allowed. If, for instance, maybe you went to a radio station to what? To go and advertise for your product. All those are what? Are not capital in nature. They are what? They are allowable. And during those periods, maybe you also distributed, you asked questions about your product and you distributed what? You distributed recharge card. All those what are allowable. Only advertising that is what capital in nature will be disallowed. Then the renewal expenses to new business premises. So you are relocating from one place to another due to due to expansion, or you are being transferred from one place to another in order for you to settle down. Those are allowable for the company and what. So they are also what? So they are not taxable in the hand of what? In the hand of the taxpayer. But where it is due to expansion scheme, so you want to expand your business, removal expenses are not allowed if the removal is due to what? An expansion scheme. So you are what? You are expanding your business. So any expenses you are going to incur to what? To expand the business. So will be so because we're going to capitalize it for what? For capital allowance claim. But if it is forced, the first of all, the cost of forced removal or voluntary removal not connected with any expansion will be allowed. Then we have foreign exchange losses. Under the foreign exchange, we can have those that are realized and unrealized. Please, for the losses, any foreign exchange losses unrealized will be disallowed. While foreign exchange losses realized will be what? Will be allowed. Foreign exchange losses realized will be what? Will be disallowed. Then educational training. Training done by your company to increase your skill and knowledge. So to increase your existing skill and knowledge will be what? Allowable. But where the training is is for you to acquire new knowledge. If, for instance, now it will be disallowed. For instance, your employer employs you as an accountant. You now want to become a lawyer or you want to become a doctor. The doctor that will be what? That will be operating in the hospital. So they now what? They are now sponsoring you. So that is what? Different from your existing knowledge. Such will not be what? Will not be allowed. The subscription to what? To professional body, recognized professional body are allowable. They are paying for what? Subscription to your of their staff to what? To ICAN, their staff that are member of ICAN, all those will be what? Allowable to NIN. Any professional recognized body will be allowable. Subscription to what? To recognized trade association, recognized body. All those ones will be allowable to the company. So those are some of the what expenses that are what that are disallowable. We also have taxable income. Any income that is related to what? To the activity of the business are what? Are taxable, such as what? Revenue or sales or turnover. They are all taxable. We have what? Discount received from supplier. They are balances charge, bad debt recover. You have said that an expense is to be a debt before. The person now pay you. So it now become an income. It will be what? It will be taxable. So all those are what? Taxable income. We have those that are non-taxable, any profit on disposal of this asset. It is not your business to be selling your asset. Any profit you now make as a result of selling your asset will be non-taxable. Any income that already suffered tax as source, frank investment income, dividend, they are non-taxable income. Any profit on disposal of investment, they are not. All those are non. Interest received from government bond, government treasury bill, or government security, they are all non-taxable income, because you are helping government to provide what? To provide fund to what? To cater for what? For the day-to-day running of what? Of the of the of the economy. As a result of that, any interest you receive as a result of what? Buying government security with what? Are not liable to tax. So those are what? Those are the non-taxable income that I will also. Then, in relation to expenses, we have expenses involving related parties. So, for an expense to be allowed as what? As an expenses that will be allowed by between a holding company and a subsidiary, that expenses must have followed the what? The transfer pricing regulation scheme. That is what the transfer pricing rule must have been adopted on that expenses before what? Before that expenses can be what? Can be allowed. Where that expenses did not follow the rule of transfer pricing, that expenses will be disallowed. Then I made mention of what? Interest on loan. That's when you are doing business. Nobody say you cannot borrow money. But where the loan is from, where? It's from a related party. That is, a parent company is giving loan to their subsidiary, or subsidiary company is giving loan to what? To a parent company. Where the loan is between what? Related party. So the loan, there is restriction on the amount to be what? To be deducted during the computation of what? Of tax liability. Because the reason why government introduces, because government find out that most of these multinational companies, they have branches outside Nigeria. They use this particular form of what? Granting of loan, interest on loan, as an avenue to what? To move fund, to move fund from Nigeria to other regions by what? By ensuring that what? They pay what? They pay lower tax liability. And government need this money. In order to cater for that, government is what? Now introduce what is called what? Interest deductible on loan. When what? When the loan is what? Is between related parties. So there's going to be a restriction on what? On that loan, according to what? Section 24 of CETA. So Section 24 of CETA now stated that when a loan is between related parties, the loan is between what? Connected person. That not the interest on loan will be restricted. The interest on loan to be allowed will be restricted to what? 30% of EBITDA, where the loan is between what? Connected person or related party. The interest on loan to be allowed in any year of assessment will be restricted to what? 30% of EBITDA. EBITDA is what? Earning before interest, tax, depreciation, and amortization. It will be restricted to 30% of EBITDA. So the determination of this EBITDA depends on EBITDA. EBITDA. So determination of EBITDA, which is what? EBITDA is any before interest, any before interest, tax, depreciation, and amortization. So determination of this EBITDA depends on the type of profit provided by you or by the examiner. The following profit may be provided by the examiner. You can have profit before tax, which is the same thing as your net profits. The examiner can give you as well profits after tax. Then also the examiner can give you accessible profits. So the examiner can provide you any of these three profits. Where the examiner give you profit before tax. Profit before tax. Where the examiner give you profit before tax. EBITDA will simply be net profit, that profit given to you, net profit plus depreciation plus amortization plus interest will give you EBITDA, where you are giving profit before tax. You are going to add profit, the profit given to you plus depreciation plus amortization plus interest. Where the examiner give you profit, the examiner can give you profit after tax. Where the examiner give you profit after tax, your EBITDA will simply be equals to profit after tax plus depreciation plus amortization plus interest plus tax will give you what? EBITDA. The examiner can also give you accessible profit. Don't forget accessible profit. So where the examiner give you accessible profit, your EBITDA will simply be equals to accessible profit plus interest. We are going to add back only interest. Reason being that the depreciation and amortization will have been what? Will have been adjusted before what? As what? As a disallowable expenses before the accessible profit can be arrived at. So the determination of EBITDA depend on what? On the type of profit provided by what? By the examiner. As I said, the interest that you are going to deduct will be restricted to 30% of EBITDA. Take note of that. And any excess amount will be what? Will be carried forward to subsequent year. After the year of assessment in which one that transaction occur. You have calculated 30% of EBITDA now. It happened to be 500,000. But you are supposed to, the total interest is supposed to be 800,000 naira. That means you'll be left with what? 300,000 naira. So that 300,000 will be transferred to subsequent year after that year of assessment for a maximum period of 5 years on what? On a FIFO basis, on a first in, first out basis. The excess amount will be carried forward to subsequent year after the year of assessment in which it occur for a maximum period of 5 assessment year on a what? On a FIFO basis, on a first in, first out basis. And not all companies that are related are liable to this principle. A Nigeria subsidiary of a foreign company, a Nigeria subsidiary of a foreign company that is engaged in what? Banking business and insurance business are what? Are exempted from it, from the application of this rule. A subsidiary of a foreign company that is what? That is engaged in what? Banking and insurance business, because majority of their transaction will be that interest. So they are exempted from it, from application of this. But apart from that, any form of related or connected activity between what? A parent company and a subsidiary will be subject to this principle of what? Of the interest deductible. And that's usually so failure to apply this principle is an offense which is punishable by what? By the relevant tax authority at the rate of 10% and what? Interest and what? And penalty of 10% and what? Interest as what? Prevailing or CBN monetary policy rate, which is what is applicable to what? To the taxpayer. Then we also have what is called what? Deduction of the taxable and non-taxable income. Expenses relating to taxable and non-taxable income. So let me just analyze that for us. Expenses relating to taxable and non-taxable income. Expenses relating to taxable and non-taxable income. So where they are saying an income is taxable, that means that income is liable to tax. Where they say an income is what? Non-taxable, it means that income is what? Not liable to tax. So the totality of total income is made up of both taxable and non-taxable income. What the law is now saying is that any expenses that relate to non-taxable income will not be what? Will not be allowable. Because you are not going to pay tax on that income, it is also expected that what? That income should not be what? That expenses should not be what? Allowed as what? As an allowable expenses. So in essence, any expenses relating to any expenses relating to non-taxable income will be what? Will be disallowed. Any expenses relating to non-taxable income will be what? Will be a disallowable expenses that will not be what? That will not be available for what? For deduction in the computation of tax liability during the process of computation of tax liability. And you may be giving that expenses in general. You may be giving where the expenses is general in nature. That is, when you are giving the expenses, you have both that relate to what? Taxable and non-taxable. You are giving only one expenses, and that expenses relate to both taxable and non-taxable income. So when you have that, you can use what? A proportion to what? To determine. Just look at what is the proportion of what? Of the taxable income in order for you to what? To determine that is that, which is what? That is what? Non-taxable. So basically, any expenses that relate to non-taxable income will not be allowable for the purpose of computation of tax liability. So those are the requirements that we are expected to know as far as company income as in based on the principle of total profits. Any question? Any question? Any question? So we're going to look at an illustration to illustrate that principle of what? Of interest deductible first. Is very, very important. This question related to November 2021 diet, question number 1. The where XYZ Limited was incorporated on August 31, 2012, and it commenced business on 31 May 2013. Dicky Malaysia is the subsidiary in Malaysia. An extract of the financial statement of XYZ for the year ended December 31 revealed the following: where profits, interest, and depreciation deducted before arriving at the net profit as follows. We have interest on loan paid to Dicky Malaysia, other creditor depreciation. Based on the information provided by the company, it was discovered that out of the loan paid to other creditor, 450 was in respect of loan obtained to generate tax-exempt profits. The managing director of SYZ approached you as the tax consultant to explain the provision of section 24 of CETA as amended and the 7th schedule in respect of the interest deductible by a Nigerian company required. Compute the interest deductible in the relevant assessment year. Explain how the excess interest not deducted in the relevant assessment year will be treated. Then see, compute the total tax liability for the relevant year of assessment. If you see a question like this, how do we know that it's based on what interest deductible? You can see they give you SYZ Limited, which is a company incorporated in Nigeria. They now give you another company, Dicky Malaysia, subsidiary in Malaysia. So that means what? There is what? A connected transaction. They are what? Related party. Dicky is what? Subsidiary to what? To SYZ Limited. There is what? There is a connected transaction. And they also tell you that what? They now borrow themselves. They gave out loan to themselves, which is giving rise to interest. So that tells you that you must apply what? The principle of what? Interest deductible on loan. In order to apply that principle of interest deductible on loan, so to apply the principle of interest deductible on loan, so as we know, the first thing is what? We look at what? The name of the taxpayer and the requirement. We have SYZ Limited, computation of what? Of interest deductible in relevant assessment year. But before we can calculate the interest deductible, we must first of all calculate EBITDA, any before interest, tax, depreciation, and what? Amortization. And we know that, and I told you that the calculation of your EBITDA depends on what? On the type of profits provided by what? By the examiner. SYZ Nigeria Limited, determination of interest deductible for the year of assessment for 2022, for 2022, for 2022 year of assessment. To determine determination of EBITDA. We need to determine our EBITDA. And I told you determination of EBITDA depends on what? On the type of profit provided by the examiner. Here we are giving net profits. And I told you when you are giving net profit, to get your EBITDA, net profit will simply be, if you are giving net profit, your EBITDA, let me go back to that before tax. Your EBITDA will be net profit plus depreciation plus amortization plus interest. So our EBITDA will be net profit. We get the value of the net profit, which is 2 million from the question, plus we add depreciation. So depreciation from the question is what? 400,000. Depreciation 400,000. No amortization. We are not giving information. We don't have amortization in this question. So in that case, so we have what? We also add interest. We have two categories of interest from that question. We have the one relating to Dicky Malaysia. Dicky Malaysia to be how much? The one for Dicky Malaysia to be 1,050,000 and other creditor 1 million. Dicky Malaysia to be 1,050,000. Then we have what? The one for other creditor. Other creditors 1 million. Other creditors 1 million. So these are the two. So we add up this. So we are going to add up this. So when we add up these two information, should give us, these two information will give us 2,050,000. So we now add it to all this. So we add all this to get what? So the addition of all this will give us EBITDA, which is our EBITDA. So this is now our EBITDA. EBITDA, which is what? 4,450,000. From this EBITDA now, they now say we need to first of all get total interest. Total interest available. How much is the total interest available? We have interest. We have one interest. The one for what? Diki Malaysia, which is what? 1 million, which is 1,050,000. Then we also have the other interest, which is what? Other creditors. So those are the two interests that this company is having. Other creditor, we have that as what? 1 million. So if we add this together, this will give us 2,050,000, which is the 2,050,000. So these two interests now. So these two interests now. From the question, let me now go back to the question. I want to point out something. We are now told that based on the information provided, it was discovered that out of the loan paid to the other creditor, 450 was in respect of loan operated to generate tax exempt profit. I told you any expenses that relate to what? Non-taxable income, which is called what? Tax exempt income or profits. Any expenses that relate to it will be what? Be disallowed. So 450 is what? Is part of these expenses on what? On interest. But that 450 relate to what? Income that they are not going to pay tax on. So what do? We are going to what? Disallow that. So you now say less tax exempt loan expenses, which is how much? 450,000. So that will be 450,000. Less that. So the resulting figure will now give you interest. Give you interest. This is the interest available for deduction. So which is what? So interest available for deduction will be this minus this. Interest available for deduction will be addition of these two, which should give us 1.6 million. But the law says that this interest, the interest we are going to deduct, should be restricted to what? To 30% of EBITDA. You now say restricted to 30% of EBITDA. We have already calculated our EBITDA to be this. So that will be 30. So the resulting figure will now give us 30 over 100 multiplied by 4,450,000. So which will now give us, the resulting figure will now give us equals to this multiplied by 30%, which will give us 1,335. So what that means is that instead of the company to deduct 1.6 in the year 2022, they are only going to deduct 1,335,000. That is what 30% of EBITDA is giving us. So you now calculate excess amount. Excess amount will now be what? 1.6, which will be this minus this will give us what? Excess amount, which is 265,000. So that is what they mean by what? Interest deductible. So we also have the solution here, which is what we have here. You can see after determining the EBITDA, you now look at the interest. So 30% of EBITDA will give you 1,335. Interest deduction is now restricted to what? 1,335. Then excess amount will now be 265,000. This is what examiner expects you to do. They now say explain how the excess interest not deducted in the relevant assessment year will be treated. I explained it earlier that any excess amount will be taken to what? Subsequent year after the year of assessment in which the interest occur, for a maximum period of 5 years on what? On a first in, first out basis. So to now explain it, you have to be specific. We now say the excess interest amount of how much? 265,000 will be transferred to what? will be taken to 2020. This is 2022 year of assessment. It will be taken to 2023, 23, 24, 25, 26, 27. We'll be taken to 2023 to 2027 year of assessment. You can see 5 years, 2023 to 2027 year of assessment on a what? On a FIFO basis. So the excess amount will be available for relief from where? From 2023 year of assessment onwards on a up to 2027 on a FIFO basis. So that's what the examiner expects you to explain. Then the third one, I'll say compute the tax liability for the relevant year of assessment. To compute the tax liability, we have the name of the company, computation of tax liability. We already know our EBITDA. Who is that person? We already know our EBITDA to be. We already know our EBITDA to be.
Sir,
We already know our EBITDA. Yeah.
sir, is it possible for in any question that the total interest will be less than the EBITDA, as in the EBITDA
Okay.
will
That
be higher than
will be the EBITDA.
the
Okay.
total interest?
Is it the EBITDA or the 30%?
The 30%, sorry.
Not the EBITDA. It cannot be more than the EBITDA. Even though if it is, that means the company is going to make a loss. So yes, somebody asked a question that by the time you calculate the 30%, the 30% is now happen to be what? To be more than what? The total interest that so it is not possible. So you cannot have what? You cannot have a scenario like that because the reason why you may not have a scenario like that is, or let us look at it this way. You can have, yeah, it is possible. Yeah, it is possible for you to, by the time you calculate the tax, because the EBITDA has nothing to do with the interest, profit before interest tax. So after calculating the 30%, the 30% now gave you a value that is what? That is more than the interest you want to compute. In that case, please, you are going to disregard that 30% of EBITDA. You are going to only concentrate on what? On the total amount. Let's say, for instance, by the time we calculate this interest available for deduction, what we have here happen to be 2 million. Interest available for deduction. What we have here is what? So, okay, let me use this same value. We have 1.6 million here now, on that year. By the time we now calculate 30% of EBITDA, 30% of EBITDA now gave us what? 2 million naira. So in that case, you cannot deduct this 2 million because the company did not their interest is not up to 2 million. In that case, you are going to restrict that amount to what you have in this value. So in that case, it's possible for the 30% to be what? To be more than what? To be more than the interest you want to deduct. So when you have that, so you are going to restrict it to what? To the amount of that interest available. It is when the 30% is lower that you now look for the restriction and transfer the balance to what? To subsequent year. So is it clear to us? So it is possible for you to have what? To have a larger amount than that. So when you have a larger amount, you are only going to restrict it to what? To the amount of what? Of the interest. So that means you are not going to be making use of what? Of the 30% of EBITDA again. Then you are asked to compute tax liability. So we have our EBITDA already, which is what? 4 million for. Yeah?
Sir, so if we are using the interest, there will be no need to carry forward any difference
Yes. Yeah, you are
subsequent
not
year.
carrying forward. Yeah, no, at all. You are not going to carry forward any different because there is no difference again because they have already considered all the whole amounts. You can have a scenario like that, it's possible. So that is for that. Then we also have we have EBITDA already. To compute the tax liability, you can either compute it using the EBITDA or using the net profit approach because we have net profit here. We have the EBITDA already to be 4,450,000. Just less interest from me. Interest that you want to deduct in this year, which is what? 1,335,000. The resulting figure will give you what? Accessible profit. There's no loss relief. There's no capital allowance. So when there is no loss, there is no capital allowance, the assessable profit will also give you what? Total profit, so which is what you have here. So total profit now, I told you, if you are not giving information about what, if you don't have information about the turnover, you are going to adopt what? 30%. So because we are not giving information about turnover here, we assume large company. Company income tax will now be what? 30%, which is what? 934,500. Then tertiary education tax for 2022 is what? 2.5% of this value, which is what? Which will give us. From this question now, you'll see that the examiner asks us for what? Compute the total tax liability. The examiner says total. So that is the reason why what these two information is being added together. CIT and tertiary education is going to be added to get what? Total tax liability. But where the examiner did not put that word total, please, you are going to separate the CIT from where? From the tertiary education tax. So that is what we mean by what? Interest deductible when there is what? When there is connected or related transaction, party transaction. Any question? So
No,
take
sir.
note that yeah, you have a question.
No question, sir.
Okay, take note that the commencement time for taxation is 11:30, not 11, no, because I usually have a class, a physical class that usually end by past 11. So it's not 11, it's 11:30. So let us take note of that. So that is our so that is in the absence of no, this is where we are going to stop the
Please,
class
sir,
today. So
sorry, sir. The record for
yes,
today, when can we have this?
the what?
The record for today, when can we have it? Because I didn't join on time.
I'm not the people posting it that with them. So the coordinator will post it, but as soon as maybe before the end of today or by tomorrow, it should be ready. It should be ready. So the coordinator will contact him to send it. Then the working notes that I'm going to send it to our group for our own.
All right, sir.
For our
Thank
own.
you.
All right. So I have a lovely. Yeah.
Thank you, sir.